In other words, we're in a situation where if you're holding cash, you're going to feel pretty stupid.
We should properly introduce him because we haven't had a chance to. Ray Dalio is here. He's the founder of Bridgewater, Chairman, Chief Investment Officer. We're always thrilled to see you and spend time with you here in Davos, and always get your ideas about where you think the market is and how the machine, you've always talked about the machine and your principles work right now. So where are you?
So I think let's particularly talk about the U.S., but I think it's generally true of the world. We are in this Goldilocks period right now in which we have had a beautiful deleveraging. The inflation isn't a problem. Growth is good. Everything is pretty good, with a big jolt of stimulation coming from the changes in tax laws and such. That is going to, at the part of the cycle, we're at the later part of the cycle. So if you look at the operating rates and you look at the GDP gap and measures, we're going to have a jolt of stimulation into that. And there's a lot of cash on the sidelines. I don't mean just investor cash. I think banks have a lot of cash. Corporations have a lot of cash. So we're going to be, I think, inundated with cash. I think that that's going to produce a lot of stimulation, and I think perhaps a market blow-off. In other words, we're in a situation where if you're holding cash, you're going to feel pretty stupid. And with that, everybody is going to become more deployed. Classically, this is late cycle behavior. And as you get that movement, then the interesting question is, how does the Federal Reserve react, or how do other central banks react? I think it's a very difficult thing to get monetary policy precise. Oh, that's why we have recessions, because you never can get it exactly right. I think it's particularly difficult to get it right now because of the fact that with interest rates so low, all assets trade at the present value of the future cash flows, so interest rates affect all assets. Because the duration of bonds and debt has lengthened, it just takes a little change in interest rates to have a bear market. And so the things that we look at are, in terms of the tightening of monetary policy, will it be tighter than is discounted in the curve, right? We have a very small amount of tightening which is built into the curve. If it is greater, and interest rates rise are greater, that can affect all asset prices.
But you're not necessarily talking about 4 moves instead of 3. You're talking about something a little greater than a quarter percentage point off, right?
It's all a matter of degree, right? We are entering that part of the cycle, right? That last part of the cycle. That last part of the cycle, I think, can last a year. But I would say when we come back here next year, probably when we're dealing with it, the issue of the preciseness of monetary policy, the delicacy, is going to be a particular issue. So I think that you're going to get a reaction. I think that the Fed should think about how much of it is this jolt to stimulation, and they should let it go. That the notion of inflation worry, what is the problem with inflation? They're struggling to get it to 2%. All the central banks are struggling to get it to 2%. We're not going to probably even hit a core inflation rate of 2% because there are other things that are happening in the economy. So let it go, enjoy it, but probably we're entering
then you got to get the last segment. But if this is the last leg, not only does the Fed have to get it right, you as the investor have to know when to be in and then clearly when to be out.
That's my game. Right. I mean, that's right. I got to know it. We all got to know it.
So, Ray, we need to recalibrate what we think is a high interest rate and what is a low interest rate, because even if, like, historically, I'm just conditioned to think that, I don't know, I'm used to 6 and 7%. So this time 5% could be high, and that could be enough to dislocate. So we need to recalibrate.
I think to calibrate it, you have to ask, what does it mean for asset prices first, and then what does it mean for economic activity? If you look at asset prices, if they're all calculated as the present value of future cash flows. So if the bond market goes down, to put that in perspective, if there's a 140 basis point rise in bond yields, you will have the greatest bear market in bonds ever. The biggest bear market. Because and when you
even though we're still at a relatively low level historically,
you can't have a significant rise in interest rates without knocking over the whole asset markets. Now, all markets, private equity, real estate, everything in terms of markets is trading at cap rates or yields that are very low. If all of a sudden you raise the discount rate on that, they're all going to go down, right? So you have a sensitivity from asset prices. The average increase in the tightening cycle has been about 500 basis points. I don't think you can have 100 or 125 basis points from here without knocking it over. The same thing is true.
Just to put a fine point on it, yeah. Joe mentioned 5%. You're talking 4% potentially, like for.
Yeah, I don't think you can get.
Yeah.
Okay, and then so for asset prices, and then if you look at the nature of, there has been a leveraging up of many parts of the company. Corporations, the return on equity was high relative to the return on cash, so the typical companies leveraged 2 to 2.5 times what they were before. Now, did they get that right? Okay, that's the key thing. So what, you're going to have a sensitivity to that. You still have a fair amount of debt. So there's a lot of sensitivity, much more sensitivity to interest rate changes than there has ever been.
So so the Fed really does need to tread lightly, but is the Fed in control, or is the market going to decide where interest rates are?
The Fed is going to determine what the level of real interest rates are.
They can, okay.
Right. The only thing that can matter, there's been $15 trillion of pushing, of buying, central banks buying. We do have an issue that we're now entering the reverse part of that cycle, right?
Right.
And so as we're looking at that, there is a supply-demand issue, because as they let the balance sheets run off and we have a larger deficit, then we have to sell more bonds, okay? That selling of bonds is a factor. Then, of course, it has its effects. It has its effect on the markets. It has its effect on the economy. So the markets do play a role, but the Fed could decide how much they're going to accommodate that or how much they're going to let it go. That'll be the Fed's balancing act. By the second half of this year, I think, and when we meet again, we're going to be talking about that. You know, did they get it exactly right, and how difficult it will be to get it exactly right?
Let me ask you about what you've called two different economies, or two different markets that we're living in terms of in the United States, which is, you've talked about sort of inequality in the country. Are you surprised by, and we're talking about the Jamie Dimon news this morning, J.P. Morgan, offering increasing salaries by 10%. You have all these bonuses that came out right after the tax reform plan. Are you surprised? And do you think that's going to seep meaningfully into the real economy?
I don't think it's going to. I don't think it's going to move the needle. Okay. What I broke the economy up is in two parts. So, because I think when we look at averages, they're misleading, because the top 0.1% of the population's net worth is equal to the bottom 90%. If you look at income, or you can't look at averages and be representative. So I broke it into two parts: the upper 40% and the bottom 60%. And I picked the bottom 60% because that's the majority of the people. And if you look at that, that's majority. It has it's had no income growth. It's been the group that has suffered the most in terms of income change has been the middle class, and so less income growth. It has the only rising death rates in the world, and it has opiates and suicides. It has a number of issues that are there. Now so I go through the calculations. I see what companies are saying that they're going to do. There probably will be about a one-time, maybe 10% pass through of that benefit in terms of trickling down to workers. So I think that there should be metrics. In other words, they really take the economics of the income, because what I'm worried about is, what would the next downturn be like? I'm not worried about an immediate downturn, but I would say that if we were to look 2 years forward, okay, probably right before the next presidential election, there is a good chance that you will have a downturn. And if you have a downturn for that segment, I'm worried about how we will be with each other in that element of cohesiveness. I mean, basically, the formula for having problems, social and political problems, is have a lot of difference between rich and poor people who their budgets are tied together, so they have to decide on those things. And you have an economic downturn, because there'd be a lot of arguing. Are you concerned about what that will be like if you have a downturn?
I think we may.
We're getting along so well now.
So I don't think when we look at the stocks, when you look at if you look at how it passes through, let's say revenue growth, we've boosted after-tax earnings because of the changes. It's great for shareholders. And then if you look at the percentage of revenue that goes to profit and the percentage of revenue that goes to the worker, there's been, it was typically profit has been about 7% of revenue, and it's gone to about 14% of revenue, and the amount that's gone to the worker has gone less. That's capitalism, and because we invent better technologies and do such things which are wonderful for productivity in its various ways. But there is a question of how that's working for the majority of people. So I don't worry about debt service payments. I don't worry about inflation. I think we're in good shape. Just let's just let it go a little bit. But I do worry about a downturn with that set of conditions.
I mean, the age-old question is it make more sense to try to divide a stagnant or lower pie more evenly, or to hope that the bigger pie somehow divides itself more equally? I mean,
I think you and I would agree that that group, you can't give away money. If you just give away money, that's not good for, it's not going to make people productive, and that's not good for their state of mind, and it's not good for productivity.
No.
But to find ways to make those people productive. I think there should be a national initiative, a commission that's basically uses metrics of that particular group and say, how do we do that probably in private-public partnerships, so shareholders say, I can buy into that particular program that's going to be able to have an effect. And because if they're going to do it, because you have to develop, you have to have usefulness for that population.
Well, it all comes down to the work and the dignity of work and the skill set you need to be productive in the dignity of work, right?
Yes.
So it all comes down to that.
That's right.
We've got to figure that out. That's why we're in Davos.
We got to run, but you did mention this idea of a recession before the next election. Do you think that's going to change the course?
I think it would make greater polarity. I think the left will be more left and the right will be more right. And I think this isn't just an American phenomenon. If Macron doesn't do well in France, we'll have a choice between two extremes.
Right. The left can't get any more left. There's no room left of left where they are right now. It's impossible.
That's true.
And I got to ask you before you go, last time we saw you, you said you thought Bitcoin was a bubble. It hadn't even gotten to 19,000 at that point. It has come off since then. Have you have a new view?
Well, it was a bubble. It's a bubble.
It's still a bubble.
But well, no, you know what bubbles are. They have their own particular dynamic. A perfectly good market can be in a bubble. .com bubble. We had internet companies and so on. They had a bubble and then they had a bust. I don't trade I don't know how to value it. I believe in the blockchain technology. I think it's great. But that notion of how to trade it and value it is not my expertise, so I'll keep my mouth shut. But that was a bubble. It looked like a bubble.
Okay, we're going to leave it there. Thank you.
Thank you.
Great conversation.